Okay, we're recording. This is John Shealy with Tax Practice Pro. Today is August 31st, 2017. Welcome to our 2CE 100-minute webinar, What is the Correct Installment Agreement Payment, with subject matter expert Mark Dombrowski. Actually, we had a great speaker lined up for today. She couldn't make it. Mark is filling in. I'm sure he'll make it work. We will run for at least 100 minutes, which is the requirement from our friends at both NASBA, the Internal Revenue Service, and if there's anybody on board for CTEC, we do have to go run 100 minutes to reward the 2 hours. We'll stay on after that for as long as reasonable, answer your questions. The entire thing will be recorded, and of course that recording is available for later playback for you. This is a paid webinar. We're probably not going to put it on the YouTube channel. You should think that if you paid for something and your friend didn't, maybe you shouldn't share it to encourage us to make more of these. The free ones you can share. We don't think you should share these, but you know that's on you. So there are a good number of folks on the board. We will take about a week to issue certificates. We will upload the PTIN, the data to the IRS by Friday. If we have a problem with your PTIN number, we'll get a hold of you. If you have any questions during the material, please enter it into the question box. Of course, Mark or I will answer. Probably I'm going to read it to Mark, and Mark's going to answer. Actually, there's a chat window open where I even give him the answers as needed. But in any event, Mark, kick it.
Thank you, John. Last week's webinar was very successful, fun. We had a wide audience. I haven't talked to John about this, but I'm thinking of totally redoing, not totally redoing the material, but representing the webinar again for money in order to get further into the material, possibly get some of the questions that weren't answered. So it was just, I felt, a good enough webinar that it could be repeated and recorded now that we figured out how to record it with the video. I just wanted to have that a second time. In my mind, that's what I thought of. Same thing with this. This webinar, I kind of feel that any webinar can be redone a second time just to get people who hadn't gotten it the first time.
You know what, Mark? I just want to interject one thing. So one, it's Mark's joking about money. It's not always about money, obviously, based on pricing we're doing. But also, two, we are not trying to you can't hear me?
No, I'm mocking you.
Oh,
but anyway.
We're not trying to replicate what NTPI or, quite honestly, any of the other people that are out there doing 2 or 3 day events. We think there's plenty of let's look at a casework, plenty of before you did NTPI, and plenty of real-world post-NTPI work, and that's really what we're looking to do, and we're open to suggestions as well. For one thing, Mark, we didn't talk about one thing, but some feedback I got from people was I guess they've been watching too much Netflix, where you see all 10 episodes, because I got that New York State case last week. They all want to know what happened. I said, I don't know what happened. It was last week's case in real time, you know? So maybe you need to almost do like Car Talk and Shark Tank do, which is, let's revisit, you know, when we're lazy one week, we'll just revisit all the cases and see what happened. Anyway.
Honestly, John, I thought that's what we were doing. I honestly, I had, remember, okay, when we first worked this out, it was going to be working at a case, and as Lily Tran, the impetus, I don't know, the person who made, the person who forced John and I to do this, Lily, if you're out there, I love you. She wanted to know a case, and I just signed up the 2 cases, blah, blah, blah. So I was planning on continuing these cases every period of time. So I agree with that 100%, and I think we should do it. So with that being said, a potential client that I had recently, and I put this on Facebook because it was annoying to me, and I happened to look, I searched her name, and we had 23 emails back and forth to each other, and she'd still not given me, she actually did give me 40% of my retainer. The first page, as I'm scrolling down here, the first page of your material has what I basically came up with after the email with her as to the flow of a case as I see it. Is this perfect? No, it's just off the top of my head, but I will say this is what I want to go over right now, which is the process from my practice standpoint for any client is as follows. Client agrees to hire you. Client file is set up. The power of attorney is filed. Establish a relation with the IRS. That's an important key right there. That's when you're on the hook. What I will say to other tax professionals or clients is that it's real when I file a power of attorney. When it's signed and sent into the IRS, that is when I must be compensated. Have I put in powers of attorney without being compensated for unique situations? Absolutely. Everybody has their freebies they do, or different situations where they're sure the person's going to sign up, so they will submit the power of attorney before they got a dime. Whether they end up getting stiffed, you have to live and learn from life. But for practical purposes, once that power of attorney is filed, faxed in, which is the term filed here, faxed into the CAF unit, the Central Authorized File Unit. Once that is sent in, then it's real, and that is when I feel there's over the years, I have been in situations where clients were talking about their relationship, and I can sit there from any standpoint and say, listen, I filed a power of attorney. This case started. You can't go back now and say, oh, well, you didn't do anything for me. It's not as if a 30 seconds walk over to the fax machine is worth their money, but it is where the relationship is established between you and the IRS, validated by the taxpayer. One thing I do want to say, I do have terms, so a glossary of terms here in your agenda. Number 10 says terms or glossary. It is actually page 5 of the written material that I'm scrolling rather fast through your thing here because it's really only a half page. Right here, terms, the BMF, CIS, CSED, DDIA, IA, IMF, POA, PPIA. I am going to obviously be speaking and saying these words, so you don't have to worry about scrolling down. We're looking through your material on your end for the terms, but I just wanted to make sure that right in the beginning, in future webinars, we're going to put the terms right after the itinerary. That's what John and I agreed to.
You know what I think we're going to probably do too? We probably should just have a separate document for terms and load it up into every one of these webinars.
Mm-hmm.
You know, a glossary of representation. Did you do that? Glossary of
hold on.
There we go. Glossary of representation terms, and just make it a static available document. That's probably an idea.
I can't. I'm having trouble getting the. There we go. Okay. All right. Making this a little bit larger here. All right. Now, because I lost seeing you, John, but let's just make it big.
I can see you, Homer. Oh.
All right. Well, next thing after the power of attorney is set up, we need a full financial statement, which is secured from the client and perfected. The perfection of the financial statement is the art. The perfection of that financial statement is where we earn our money. It's where we interview the client, we secure supporting documentation from the client, we second guess what the client has given us so that we can figure out what the true nature, not the true nature, the true flow of income and expenses are from this client. That step can take from a week. I just want to say it could take a week. It could. If your client stuff is together, you can get this done. The problem is with these types of clients, which are generally procrastinators, that will take several months. Depending on the client and since the true financial relies on several layers of supporting documentation and the overlay of the national standards, and your financial statement is constantly changing because you're looking at a current status, that's the most critical part of the relationship with the client. Clarice and I were discussing a little while ago, I indicated in my material that I feel that a rep who is paid for representation should get a financial statement every time. That is obviously not 100%. The person walks in the door and they owe $30,000 and they can pay $750 or $1,000 a month, and they tell me the guy makes $200,000 a year and he's in Cleveland. I'm not going to bother doing the financial statement. So my advice from a practice standpoint to you guys starting out, earn your dough, get the financial statement, work the financial statement. The client will, in my mind, feel they're getting more bang for their buck. Just my 2 cents. There are practitioners out there that are not doing anything wrong by not getting the financial statement every time. It's just what I'm telling you, which is what you've hired me to do today. Number 3, after review of the IRS position and the current financial, you want to put up your door A, door B, door C. What is going to the IRS? What are the recommendations for resolution that you're giving to the client? And you're going to say, I suggest door B. I think that, and one thing is you're going to pay all of it, pay some of it, or pay none of it. I think you should go to door B, which is you're going to do an offering compromise. Now, in door A, which, not to say that door A are always pay all, pay none, pay some. Door A, the options are out there. When you come down to the pay all status, pay all could be they sold a house or another asset, they liquidated a bank account, they liquidated an IRA, a stock position, they took the money out of their savings account, or also in pay all is an installment agreement, which is what we're talking about here. Well, pay all is not an installment agreement. Yes, it is. When you think about it, the person is going to pay the entire liability in an installment agreement. The moment that you establish that installment agreement, you're looking at $28,000 divided by 72. The installment agreement is established on that basis. Whether the person has refunds in subsequent years that pay it down, plus penalty and interest that will be accruing on the liability, that will mean that the number does change, the number of months are going to change. But the moment you set up that payment plan, it is a pay-all situation. Number 4, depending on the client's wishes. Obviously, they're going to say, no, I want to do this, I want to do that. Everyone wants to pay less. Everyone does not want to hear the hybrid pay-all situation. You're going to initiate the option. That's in number 4. Number 5, resolutions, and a little parens around that S, are submitted to the IRS for review. You call ACS, you do a verbal financial statement. You submit a signed 433A to a revenue officer. You submit a 656 and a 433A OIC to the taxpayer for their signatures, and then you submit it. The resolutions are negotiated with the IRS. That's a crucial thing. Where this client and I had a little disagreement is she had indicated that my initial fee was meant to be for the entire case, and I had to educate her on steps 1 through 10 and the steps that she was paying for, which are really 1, 2, 3, 4, and a little bit of half of 5, I guess. In the case where somebody pays me a good amount of money, and depending on how much work I've had to do for that amount of money, I might include in my initial fee the words, this will include a submission of a financial statement to the IRS. Because I know darn well we're going to have this financial statement done. I know that the case is going to be within a parameter of a number of hours, a number of months, and I'll throw that in there.
Hey, Mark, can I just stick something in here? So, I talk about you behind your back?
All the time.
All right. So I was typing it somewhere where they were talking about how to charge. And of course, we weren't talking about specific dollars to charge, but we were talking about methodology, which is always permissible, right? So I said that you get the as much as I can get. You're still charging your $19.94 fees, but you do get most of the money or as much as you can up front. And then even if you're fully paid, there's always some maintenance fee you get monthly until the case settles to keep, I guess, your focus on it, but to keep the client I guess, enticed to or excited to get this thing closed as soon as possible? Why do you have a monthly maintenance fee? So if I give you $2,500 to get me an installment agreement, why do I then pay you $250 a month maintenance fee?
All right. So what you said is not entirely accurate.
It won't be the first time.
My if I probably have 4 different initial retainer agreements, initial fee arrangement formats. And if it's a flat fee, it's a flat fee. This is going to be a flat fee for a period of time. It's going to be for the first 40. I like to do the first 30 or 45 days. That's what I like to put in my initial retainer agreement. X amount for the first 45 days of work. Am I going to, if on my own I decide 48 days, 60 days, 70, 80 days because something has happened in the case that I didn't anticipate, or even if I did anticipate it, I just decided on my own, because most of us are our own practitioners, I decide to move that, shoot that along, and continue the relationship without additional fees. That's up to me. That's on me. But I do have monthly engagement letters or contracts. So if I'm pitching somebody for $2,500 for an installment agreement, and I just actually looked at one as part of the review for the material for this class, which is contrary to what I'm about to say. In general, if I charge somebody $2,500 for an installment agreement, there's not going to be any maintenance fee in general. The client I just looked at, because he was a third time coming back to me, and we will, if with time allotted, we'll get to that. It's my last sample question here. I was charging that guy the $2,500 down and $750 a month because he was a pain in the butt. It was $283,000. He had a complicated case. He and his wife are self-employed, and he has a W-2, and a revenue officer was involved.
That's not the shoe designer, is it?
No.
Okay.
That
was close. Close back then.
The shoe designer dude had that same dynamics because of the warnings I got from my happy referral source, John Shealy, who said, beware of this taxpayer. Okay, so moving on.
He paid you.
He did pay me all the way through, and I was happy to overbill him again in the hopes that he did not come back. We all have our subtle ways of getting rid of clients after the case. The guy wants to come back and do an offer in compromise that I've talked him out of 4 different times, but he and his CPA.
And yeah, he did fire me, right? Because it was my fault he owed that money. However, he's not a sympathetic character either, so full price anyway.
Right. So I doubled the fee in hopes that they didn't hire me, or if they did hire me.
How do you value a portfolio of 30 years of shoe designs for OIC purposes? Have you considered that?
$1,000. Put $1,000 out there and see what they say. That's the thing, like when it comes to inventory valuations, goodwill, your phone number, your client list, you have to value them. We're way off topic here, John. You have to value them, but I generally will not avoid the asset. I will put the asset in the financial statement, give it a valuation, $1,000, $1,500, $2,500, something. It could be $20,000, could be a nominal amount for this client. Let the IRS come back and voir dire our valuations. That's my feeling. All right. Moving quickly through the rest of this list. Number 6, resolutions are negotiated with the IRS. That's where you earn your money. You earn your money here with the financial statement perfection, because it's the most crucial part, but your submission of that financial statement and your negotiation of that financial statement is where you really earn your money. Clients have a very difficult time trying to piece together that 5 months from now you're going to review the offer and compromise with someone at the state or the IRS. And what happens during that time? Well, sometimes the answer is nothing. You're just waiting your place in line. But depending on your pricing, you may still be getting paid every month for that. It's a different class, but what I'm shooting at is that number 6 is where you get paid for your experience. 7, the IRS may alter our proposal. IRS wants an offer in compromise of $80,000. We offered $40,000. IRS wants a payment plan of $1,300 a month. We offered $800. Resolution is either accepted by the IRS or the client, or an appeal is filed. We either say yes, the IRS says yes, then we don't like it, we can always file an appeal. Ultimate resolution is agreed on by the client, and possible secondary resolution is reviewed. Case in point, we get the case of C&C, currently not collectible. The IRS, that gives us the breathing room to do an offer in compromise down the line with another fee agreement. So that's why I threw that in, possible secondary resolution. All these cases are not just cut and dry. Many times, a case is a stepped approach. Well, what about penalty abatement? Well, we'll throw that in. Once the payment plan is set up, we'll throw in penalty abatement. We'll do that now. Let's not get distracted. One of the key things before I leave this first half page is that control of a case is your power. You cannot let the client walk all over you. You cannot let the client determine where you're going. You need to move them gently back onto track. For example, we're talking about installment agreements. If this is an installment agreement, many clients, when they finally realize that, hey, wait, I'm paying $80,000, 210 cents, plus interest and penalty over the next 5-6 years, where the heck, why did I hire this guy or gal? When they get to that realization, sometimes they start pushing you for penalty abatement and reductions. They start pushing you for an offer in compromise. Yes, I have the confidence, I have the experience, me personally, to steer clients back on to the track. The only way I can impart to you that experience or that confidence is to just explain it to you as best I can. You can only get it through having experience. And as I always say to people, it's like walking down a bad neighborhood in the dark when you're alone. You stick your chest out and you walk. You keep your eyes about you, but you walk through it.
Hey, Mark, I have to put up a poll question real quick. So if everyone would, you can keep speaking if you'd want, but there's going to be 4 polls. I need you to answer 3 of the 4 polls to get full credit today. And we both live in New York, so how far apart are we? We frequently get that question if we speak at the same event. Oh, did you drive in together?
Did you drive in together? Wait, that's our poll question?
That's the first poll question, yeah. I got to ask 4, so it might as well be some fun.
Got it.
Obviously, how many folks don't know New York geography?
Okay, so moving on. This is something I just copied and pasted out of the IRS, off the IRS website. The changes to user fees effective January 1st because we're talking about installment agreements.
Hey, did the IRS website change recently?
No, it's been the same for the last 35 years.
Oh, yes. You posted something about being lost.
It changed, I think, today's Thursday. I think Wednesday morning or maybe overnight, which was funny because the IRS gave us this huge thing. Oh, my God, we're changing our website. We have to be down for, what, 4 days? We lost a whole, they said, Thursday at 6 p.m., coming up on, would be coming up on the next Monday at 6 a.m. We're losing a whole business day of Friday, which is really kind of terrifying to me. And then they ended up the last minute saying, nope, we don't need to do it. And then, without telling anybody, they changed it overnight. I'm paraphrasing here with my reality. They changed it overnight, and it's totally different, and it didn't change anything really with these services. I know Roger was talking about, Roger Nemeth was talking about how his software is compliant with that. So that's something Roger has to work out so that we all pay him. All right, getting back to
the answer to the poll question. Buffalo was actually, or Eden, where Mark is about, or Hamburg is 325 miles from where I am today. So he's almost in Ohio, and I'm close to New Jersey, Pennsylvania, and Connecticut. In fact, to drive through Pennsylvania to get to Mark, I can be in Maryland before I can be to Mark's office.
That could be true, yes. And we're certainly not. We don't go out on a Friday night for a beer. Not in this. I probably go out with John more than I do my brother, who lives 40 miles away. Okay, so here are your fees. Now this is sort of this number. They they almost doubled the fee. The first number, regular installment agreement, $225. I happen to have a friend who owed the IRS $1,800 for this year. To him, a fee of $225 was prohibitive. Generally, my clients who owe $50,000, $80,000, who cares? It's $220. Yes, you try to minimize. The reason I'm showing you this chart is you try to minimize the exposure. The IRS gave us a stat, and this stat is a decade old, but I'm sure it holds true today. 80% of their regular installment agreements defaulted. 80. That's why they push just direct debit installment agreements, or DDIAs. DDIAs are pushed because the IRS found if they have direct debit, they didn't give us the statistic as to how much, at least at that point, I don't know what the statistic is today, probably something important for me to get later, is what their benefit is in direct debit. But either way, it was significantly moving them off the 80% mark to the point where they would give us a 50% discount on installment agreements for direct debit. They would also not file a lien in certain categories, as we're about to find out, with direct debit. So you've got your online payment agreement for regular installments, $149 now, and then the daddy-o of the smallest amount, your client does an online payment agreement, direct debit installment agreement, $31. A question comes up to me from time to time about using the IRS online system. I don't. The online direct installment agreement. I kind of feel that it's like I'm a chef at Morton's Steakhouse and I eat at McDonald's. It's a situation where people hire us to do something. There's a train of thought, Mark, why take the hard route to get to an installment agreement when I can log in? The issue is the login, and I don't know how that's been changed, if at all, through the IRS website change, but the login requires certain things that the taxpayer needs to be around for. Or when we use this online system, it could be said, why didn't we earn our money? But again, two paths in the woods. Which one are you going to travel? I'm not going to sit here and tell you what to do. I personally like to do the regular methods in my world, setting up through ACS, using a 9465, which is the installment agreement request, a 433D, calling practitioner priority line, whatever it is to get installment agreements set up. I have done two direct debit installment agreements online with a client present in the room when I did it. Both of those cases were a low fee or no fee situation. So some guy gives me $2,500, I'm not using the online direct debit or online system.
Mark, calling PPS, hundreds of these, right? I mean, at the end of somebody owes money at the end of tax season. I get an extra fee right then and there when we do the return. I take the power of attorney. I get the demographic information, how much they want to pay. I call PPS when the notice comes here, right? You file the power of attorney right away. In a month, the bill comes here. And I have never once had a plan set up with PPS or ACS over the phone not happen or go south. Have you?
I guess the answer is yes. I've certainly had payment plans go south.
No. When the assister says to you, X dollars this day of the month, you're good. Have you ever had that turn out to not be true?
I don't understand your question. What do you mean? How would it not be true?
And that's what I'm getting at. In other words, I've gone online and had something not come.
Oh, I see what you're saying.
The benefit. When the employee on the phone says to you, Mr. Smith has an installment agreement 28th of the month. By the way, every installment agreement in my office is the 28th of the month. So when people call me up and ask what day their payment is due, I know it's the 28th. But I've never had one where the assister told me it's confirmed and had it not be true or had a problem occur. I've had people not pay, but I've not had that problem.
I have had the problem. Very, very rare. I can't say it's never happened, but it's rare that an ACS established verbal installment agreement goes south, there are different reasons why, but I agree with you. The benefit of working with a human as opposed to a computer is the computer, you hit a brick wall. You don't know why the installment agreement is not set up. You don't know why the cell phone number that you use to verify the person's thing, and the person sitting there saying, no, this is the bill, I can show you my bill, it has my name on it, why the IRS isn't verifying it, we don't know. I agree with you 100%, John, that in the reality of trying to get a resolution right away, talking to a person, obviously I endorse. Because the computer will just say, no, can't do it, or you get these dumb screens on your computer of the where it's just saying that the link doesn't exist.
Right.
So, all right. Can
you take a couple? Sorry, can you take a couple of questions now?
Of course I can.
Okay.
You there in the blue shirt, right there.
Yeah, me here in the blue shirt. Thank you very much. Little John, long-time listener, first-time caller. Anastasia, oh no. So David wants to know: are you always negotiating with just ACS or also ROs?
Am I? It's probably, unfortunately, it's probably 75 for me personally right now. 75% ACS and 25% ROs. I say unfortunately because our RO cases are higher retainers, so higher fees. So I want to get as many RO cases, many corporate cases as possible. And so yes, I am. Am I all? I got. Is that answering the question? Am I? Did you read it the right way? My 75% ACS.
So Lynn asks, remember when you were talking about secondary penalty abatement?
Yeah.
All right. So would that process be subject to a separate engagement letter and a separate fee structure? How do you do that?
The short answer is maybe. If we knew it ahead of time, so I will do if in that initial meeting I can anticipate that the client is going to be an installment agreement and penalty abatement, I will write it into the first agreement, for example, and I will quote the fee accordingly. So if I think I'm working on a fee for just an installment agreement, let's say it's $1,500. And please, as I say this a million times, I need to raise my fees. So let's just say it's a pretend fee, $1,500. And I say to myself, this guy's has got one reason for doing penalty abatement. It's a pretty darn good reason. I like it. He's good for first-time abatement, or he's good for on a medical. You know, it's morbid. Penalty abatements are so morbid. His wife had cancer, for God's sakes. He's got a good, which means morbid, reason for penalty abatement. I might throw on another $250 or $500 in the fee for producing the penalty abatement letter, and then throw in that same agreement. So say it's $1,750 fee for the installment agreement, including a penalty abatement request. And I say request. I don't say penalty abatement that it's affirmatively going to happen. I will say a request. I will also say a request for installment agreement to the IRS. I won't say your flat fee is $1,000 for an installment agreement with the IRS. I'd like to say to request an installment agreement, because I've gotten burned on that, where the guy's got everything that we worked on an installment agreement for blew up in my face. Well, the guy didn't tell me the truth going in. Now I'm stuck with a retainer agreement that I want to honor, and looking at additional hours to put in. So I would say I add a little bit more to that fee for the production of a penalty abatement letter, plus a percentage of savings, 20%, 10% of savings. At a referral client right now, his penalty and interest alone are $195,000. Of that penalty, $45,000 is interest of that $190,000. So he's got $150,000 of penalty that he's rock solid for a first-time abatement and a medical. So in that case, I did a 20 or 10% of any savings with a cap. I'm not going to ask this guy for $20,000 or $15,000 if I write one letter. maybe, again, bad salesman. Mark, you're a horrible capitalist. I just wouldn't sign that deal if I were that guy. And I try to live life that way a little bit.
Circular 230 does have that unconscionable fee limitation, which is undefined.
Right.
So a third of $10,000 unconscionable? Is a third of $150,000 unconscionable? I don't know.
So I would write in a 10% of a minimum fee on a penalty abatement. All right. So let me just say installment agreement fee. Add a little more for penalty abatement if we know right off the get-go, plus a 10% thing with maybe a cap. That same guy comes into the office, we do the installment agreement, or we do the case, I do a look-see or a review, God, what we were calling it yesterday on the internet, which I really liked it, a survey or a review. I like to call it a look-see. You get the money, and it ends up the guy's going to have to full pay through an installment agreement, and everybody, you included, want penalty abatement. That we didn't anticipate it the first time. So to answer his question, yes, you absolutely can have 3 retainer agreements, initial fee agreements, in the course of the life of a client's file. The secondary stage is, hey, I looked at this. Let's do penalty abatement, and there's an additional fee I charge for that. It's a nominal fee. You throw a number out there, whatever you feel comfortable with, depending on how long it's going to take you to type the letter. I do have so many templates in doing this for 20-odd years that I do have a leg up on the production of a penalty abatement letter, plus 10-20% of savings. Is that agreeable to you? I'm going to send you a new initial retainer agreement. Sign it, get it back, pay me the fee. Let's move on. Any other questions?
Next question comes from Valerie. When the 9465 is sent with the return electronically, what kind of installment agreement is that?
That's going to be 72 months, so that's going to be a streamlined agreement. That's our answer. The answer is it is going to be a streamlined agreement, which we will discuss.
So wait, I want to add one thing to that. Do you know how often you should do that, send the 9465 with the tax return?
I think your answer is 0.
My answer is never. 2014, we had a whole bunch where the IRS got behind on them. The summer of hell on the telephone. IRS didn't process these things. They got behind. So for those of you that don't know this, the 9465 is not processed electronically. The Operations Center will print it out and send it over, physical piece of paper, which they may fax, but they send it over to the input group. And the input group eventually inputs it. Sadly, the collection process continues while that 9465 sits in a bucket. There's also no perceived value. So get a power of attorney, get a fee from the folks, fax in the power of attorney. After the return is filed, you'll get the bill, call PPS, and settle it. Anyway.
I can't say I never send out a 9465 with the 1040. I think that like John, I'm very suspicious of the legitimate resolution through sending it with the 1040, but sometimes I do it. Okay, installment agreement, page 3. Page 3, installment agreement cheat sheet. And this, what we're going to talk about right now, we're going to go back to during the presentation, because this is something that, this is something that you might want to have an extra copy of, cut and copy it, put it in a drawer, put it on if you're doing a lot of collection work, tape it up to a drawer that you, along with your other IRM sections that you like to reference in a coming business day. This thing, along with other charts, and there's a lot out there. There is another link that that Clarice sent to me today. There are definitely links for charts. I didn't include Clarice's reference because, as she said, right when she sent it to me, it needs to be updated from the IRS. It's right on the IRS website right now, but it needs to be updated. Let's go through this. And this is what I referenced to before, for any client, do the financial first. Nothing is ever absolute, but this is my recommendation. Do the financial. Apply the IRS National Standards, which is a different seminar, and see what they can pay. I didn't mark these 1, 2, 3, 4, but the underlined areas is what your focus should be on. tax of $10,000 or less, a very compliant, really compliant person, and on page 4, the top of page 4, I copied and pasted what they're talking about, numbers 1 through 6, is a really compliant person. They can get a guaranteed installment agreement over 36 months. Number 4, agree to full pay the tax liability within 3 years, 36 months. The only reason I mention this is because people say, is there a guaranteed installment agreement? In my world of collections, the answer is no. But here it is, because who, when they can pay it over 72 months, wants to pay it in 3 years? How many of my clients only owe $8,000? Not a lot of them. Is why, in my world, guaranteed installment agreements are not such a reality. Certainly when I'm giving a class on installment agreements, that should be mentioned, that there are actually guaranteed installment agreements. Assessed balance. Let me give my 30-second assessed balance definition, because there's a lot of confusion over that term. You file the client's 2016 return, they owe 10 grand. Let's say you file it late. He comes to you for some reason, comes to you May 1st, has not done an extension, you file the return. He owes 10 grand in raw tax. He's going to have failure to file from April 15th till May. He's going to have failure to pay tax, at the very least, April 15th to the first time he gets a bill. And that's important. First time he gets a bill is important. Interest from April 15th. Failure to estimate. So there are 5 elements that he gets in that first bill. Tax, failure to file, failure to pay, failure to estimate, and interest. Those 5 things, the calculation, he gets a bill for $11,110. That number is called his assessed balance. That number is the benchmark. That number is the threshold of all other IRS calculations of tax, penalty, and interest. The IRS does this to save computer space. Back in the 90s, I used to say, well, if interest is calculated daily, I'm assuming it's at 12:01 every night, and maybe by 12:04, the IRS computer will burn out just calculating my client's liabilities for the next day. That's a joke, by the way. At home, you can clap. We won't hear you. You can say LOL, different stuff like that. But the point is, somebody smart at the IRS said, let's not do things at 12:01 every night. I don't know if they ever did. By establishing the assessed balance premise and establishing that threshold of a dollar amount, all the IRS computer has to do is forever remember $1,104.10, and then when a user like us in e-services or an ACS rep or an RO comes into the system and says, what does he owe today? They start with that benchmark of $1,100, add additional penalty and interest called accrued penalty and interest. So I'm thereby giving you the definition of assessed penalty, assessed balance, and accrued penalty, accrued interest. The definition of accrued penalty is any penalty that is assessed against the taxpayer after a first assessment. Same thing with interest. Accrued interest is that interest that is calculated by the IRS computer after the billing date, the first billing date. So the client gets a notice called a CP14, which is his initial, generally, I'm not talking about stat notices, different stuff. Most run-of-the-mill, they get a CP14, their 1040, 2016, 1040 has been calculated. He owes $1,100. If 8 months later I come by and I say, what's his dollar amount, I'm going to get a number of $1,280 and 44 cents. That difference between the $1,100 and the $1,200 is the accrued difference. I'm telling you that because it's important for what we're about to talk about. Assessed balance of $1 to $25,000. Remember, if you look back to the line above it, 10,000 is obviously in that number. 10,000 is a number that's in between there. You can still get a 72-month payment plan if the guy meets all their parameters of a guaranteed installment agreement, but you want it over 72 months. So I was talking to an EA last night at 11:30 last night. I was talking to somebody about that. They were confused. Assessed balance of $1 to $25,000. You have 72 months. Or the CSED. Definition of CSED, the collection statute expiration date, that magical 10-year number from the date of assessment, not the date of filing, but the date of assessment. So the answer is, Mark, if my client owes $23,000, what sort of installment agreement is a streamlined installment agreement that I can get every time? My answer is 72 months or the CSED, whichever is less. And that does come to bite you many times. I had it last month where I had a drop-dead $1,000 a month payment plan, but it ended up they wanted $3,500 a month. The CSED was coming up. So there are many cases where a collection statute is, yay, and I'll show you one of those. Hey, some of it fell off the statute or it's close to falling off the statute. Not such a happy time when you have an RO and you have a client who makes a decent amount of money. Let me finish reading the rest of that sentence. 72 months of the CSED, whichever is less, no financials required. But Mark, you said to get the financial every time. Part of the disconnect between sometimes what you want, what you can get from the IRS because you've heard this class, you've heard it, you know it, you do representation, you know no financials is required. But a lot of clients still want to know, what can I do in an offer and compromise? A lot of clients want to know what their options are. You won't know those options if all you do is take $23,000 and divide it by 72. Does that resolve the case? Yes, it does. Do you get paid the same money? Yes, it does. Even though no financial is required, I will recommend, especially for starters, especially for people who are starting out in representation practices, get the financial. Continuing on this sentence, no financial required, no federal taxing is to be filed. Have I had clients who owed the IRS $6,000 have a lien filed against them? Yes, I have. Because I didn't ask. Because these rules weren't being followed. I have a tongue-in-cheek statement. No one at the IRS will ever be yelled at for filing a lien. They will be yelled at for not filing a lien. Tongue-in-cheek, by that I mean there are mistakes that everyone makes. I bought a lemon that was the first year of a View, a Saturn View. Absolute 50 mistakes were made on that car. People at the IRS will make mistakes, as John was talking about key punching and of the 9465s. People make mistakes. They're human beings. If you don't ask or verify and say, I'd like to make sure you note in your history that I'm requesting that no lien gets filed. Oh, yeah, that's automatic in these streamlined agreements. Don't worry about it. No, please note the file that I asked that no lien be filed. Thank you. No DDIA, direct debit, is required. For IMF, and this is in the terms, individual master file, people, individuals, BMF, businesses, out of business, or for business income taxes like 1065s, 1120s. You can use this 72 months. Okay, that's the first, that's the big one. What this expanded Fresh Start streamlined gave us is the next line. $25,001 assessed balance to $50,000. Same 72 months, or the CSED, no financials required. The tax lien is to be filed unless it's a DDIA. So my recommendation is say to the client, listen, the IRS can file a lien on this. This is $48,000. It's not chicken feed. We're asking for a 6-year payment plan. If I were the IRS, I'd file a lien against you. Let's do this as a direct debit installment agreement, which, by the way...
What did you say? If you were the IRS, you'd what?
I'd file the lien. You know, there are times when I view my life, I never worked for the service, but there are times that you have to look at life, whether you're talking to your daughter, your spouse, your best friend, or the IRS, the bus driver, you have to view life through someone else's eyes. And I say many times, when I'm explaining to clients or tax practitioners an action that an IRS agent, a revenue officer, or a rep might take, is I'd send out the levies to get this guy to wake up. I'd file the lien because I know the last 16 installment agreement cases I set up, 15 of them defaulted. And the IRS didn't. It took 2 years for the IRS to get that case back. Do you have problems with my reality, John? That I would file the lien if I worked at the IRS?
You have quite an interesting reality. So I need to ask a poll question now. Remember, you need to answer 3 of the 4 polls to get full credit plus beyond for 100 minutes. So would you pay an annual fee for a weekly May through December webinar? The webinar would happen every week whether you joined us or not. Mark, I have a couple of questions while people are answering. You ready?
I'm ready.
I got to share this. I got to. Yeah, can you see my poll?
I cannot see your poll.
Let's see. Can you see my poll now? No.
I only see you and I. You're back. Our faces are back.
There we go. You know what? I think folks it didn't update correctly. So I think 90% of people voted. If you didn't get to vote in that poll, would you give me a ring, or shoot me a message on Facebook or something, and we'll take care of that for you.
A question here. What would you do if a client can't afford to pay 10% of their savings?
Oh, you can see those. I was going to read them to you.
I mean, you have to go back to screen sharing, though, I think, or did you?
I am. I'm back on screen sharing. I know. Who's in charge here? Would you knock it off? So, what do you do when, as said, you have a solid $1,000 a month case, and the IRS wants $3,500 a month? What do you do?
We're going to look at that in these samples, but the short answer is it's something you gotta negotiate. Well, let me say this way: if you do the financial and you, as I just said, you say that I've done financials, I came up with the guy could pay $4,000, and I'm like happy the IRS can only wants only $3,500. I did just set up a payment plan where the client was angry with me because it was $1,800 a month. I showed she could pay over $3,200 a month, almost double. Where's that double? And she was unhappy. She had a house in Colorado where her boyfriend lived, and she got a good job in New York, and she kept the house and bought a condo or co-op in New York. The IRS doesn't allow you to support your boyfriend back in Colorado. So I know all the expenses of her Colorado household are going to be disallowed. She was not happy with an $1,800 a month payment plan. The short answer is, this might not make a lot of people happy.
What did she want, a 0 payment plan?
I'm pretty sure, I don't remember, but let's say she wanted $500. It was like $500. The girl's making a lot of money. She's crying. So the short answer is, you've got to be able, again, with confidence and experience, explain to your taxpayer why their error of reality is an error. Look, honey, you don't say that, obviously. Look, ma'am, you're making $280,000 a year. The IRS, these parameters are made for a lot of people making under $60,000, $80,000 a year. There's gonna be some pain here. It's not gonna be pretty. You have to accept. You have to accept that you're gonna have to move some things around in your budget. Again, I'll talk about this actually right now. In the same page, so we'll see this.
Let me hit a couple more here, Mark. If you charge someone $250 to submit a first-time penalty abatement, you cannot charge them the 10% as well, correct?
No, why not?
Right. Well, I don't know. Isn't it one or the other?
No. Circular 230 was changed about 4 years ago. We can do. It's two. So, like my consultant agreement might say, using this person's example, 250, which is sort of so low, 250 plus 10% of savings. 250 was a non-refundable fee.
This was for an FTA, Mark.
So what is that? There's
okay.
So just because it might be easy, doesn't mean that I can't charge both, 10% and the 250. So. But ideally, in my agreement, I guess maybe the answer is yes to the person's question, because generally it's sometimes I say 250 down plus an additional 10% of any savings cap of whatever. Again, if we want to look at that kind of number, I will, depending on how easy things are, I will always have the option of cutting the fee to the person and say, listen, you already paid, it's $1,000, you already paid me $250, just pay me another $750. But the answer to the question is I can charge both if I wanted to.
Okay.
We do need to get through this, John, so some of the questions might be answered, so let's do what we did last time.
All right.
Okay. Now, next item, assessed balance of $25,001 to $50,000, or I already did that. Okay, so no DDI required for this, we're still on it, for individuals and businesses out of business or sole proprietors only. So a lot of these do not apply to corporations. Corporations with 941 liabilities that are ongoing operations, ongoing entities, these streamlined agreements do not apply to you. Assessed balance of $50,001 to $100,000. This was also part of Fresh Start. Gave us 84 months, or the CSED. So in some ways, if somebody owes $54,000, they just gained another year to pay. One of the things that I will talk about is, are you doing your client any favor by getting them the absolute minimum payment? There's no yes or no answer to that question. There are times I will round up on installment agreement amounts based on what the client told me. We'll get into this in these sample questions. Sometimes, because of the accruals of penalty and interest, there's a little tough love involved when you're sitting there in your seat and you have everything in front of you and the ACS rep says to you, listen, we can do $500 a month. And I know the guy can do $3,000 a month. He's making, I'm throwing $800,000 a year. The guy should be paying $600 a month. Am I doing him any favors by getting him $500 a month at 10%, at 4% interest and 6% value to pay penalty? So there are some times where you round up, and not ugly money. You're not going to take a $500 payment and make it $1,500. But there are times when, for the client's better financial position, you get this creditor out sooner than later. 84 months or CSED, the financial statement is required. Federal tax lien is to be filed. No direct debit is required. And this again is for people or businesses that are out of business or a sole proprietor. Balances over $100,000. I will always ask for 72 months because there is a 6-year rule, which the 6-year rule is down here, scrolling down here to top of page 5. 6-year rule: when a taxpayer is unable to full pay immediately and does not qualify for a streamlined agreement, or those things that we were talking about, the dollar amounts, taxpayer may still qualify. May is an important part. This is the IRM. This is not law. May still qualify for the 6-year rule. Taxpayers are required to provide financial information, but are not required to provide financial statement. I'm telling you that the revenue officers who are invoking the 6-year rule, 50% of them will still make me do a full financial statement with full documentation. All reasonable expenses, again, emphasis on reasonable, which is subject to RO definition, may be allowed if the taxpayer establishes that he or she can stay current with paying all current taxes, filing the tax liability, including projected accruals. A lot of times the IRS does not do that. Can be full paid with 6 years or within the CSED. Expense amounts are reasonable. Do not automatically allow agreements based on the 6-year maximum if expenses are unreasonable. They reiterate that in the IRM. A lot of revenue officers will, if you're in a big city, they're going to give you the 6-year rule 80% of the time. That's why I always ask for the 72 months. After that, continuing that sentence, balances over 100,000, always ask for 72 months as there's a 6-year rule. After that, take the lower of what their ability to pay is, which is disposable income, and 72 months. Okay? That requires you to have done the installment agreement, or not the installment, the financial statement. So when I say you're going to take the lower of what their ability to pay is, disposable income, the only reason you got to calculate disposable income is by doing the financial statement and arriving at disposable income. The lower of disposable income in 72 months. I do the financial statement, disposable income comes up to $2,550, but I divided it by 72, and that's $1,900. The guy tells me he wants $500 a month. Well, then I am going to take the lower of that. I'm going to pitch to this revenue officer or to ACS 72 months. Moving on, 12-month rule. I also, on page 5, I copied and pasted the 1-year rule. But this is a tool. It allows a taxpayer to make some monthly payment of an expense that doesn't fit the IRS national standards, but it's actually paid. Car payment is a luxury vehicle, and it's $850 a month, $1150 a month. It gives the taxpayer the opportunity to change their evil ways, go get a Vega, a Chevy Vega, a used Chevy Vega off the lot, and dispense of their $1,100 a month payment plan. I will say I will invoke this without much hope that the guy will actually do it. Sorry, tongue-in-cheek again. The guy's not going to sell his house in 12 months. It's just not going to happen. The guy's not going to get out of his car. What's going to happen is you have another client in month 13 is what happens, because they're not going to be able to make the new installment agreement. A lot of times, it buys us 12 months. Everybody's happy. Obviously, you have to make your client aware of what you did, why you did it, explain to them that this is going to come back to bite us. Month 13, your payment plan goes from $250 a month, some nominal amount, to $1,300 a month. That's a huge number for somebody on a payment plan of $250. Now, the catch-all that's at the end of this, the last sentence, a PPIA, partial pay installment agreement, is when a client cannot afford to pay a streamlined installment agreement, but they can pay something. Client owes $1 million, and it ends up they can pay $250 a month. I know that sounds ridiculous, but I want to say it. I do it all the time. They can pay $250 a month. That's not even paying interest on $1 million, but at least the government to go buy some missiles, build some bridges, build a wall somewhere, and after Canada pays for it, this is at least get some money into the federal coffers. This is a 24-month program, and in the 24th month, mid-24 month, they send out letters asking for a new financial statement, giving you 30 days. Basically, they send out a letter called the CP 523 that defaults the installment agreement on 24 months and a day. Scrolling down all the way. Now, in here, I put on page 4, the guaranteed installment agreements that I talked about already, the rules on streamlined agreements right in the middle of the page, 25,000 or less, and at the bottom, 50,000. Just so you guys can see, I just copied and pasted these out of the IRM. These support my cheat sheet, so you see them. 6-year rule, 1-year rule, and then we have our terms, which I told you about. Now let's get into some sample cases. I wanted to provide you guys with some sample real-life cases. Paul E. Paulie. 1040s are unfiled when he comes to you. Unfiled for 2010, 11, 12, for some reason was filed. I think his wife, these are all going to be married filing separate. He was married this entire time. This guy actually was a CIA operative. I have 2 clients who are CIA operatives. At least that's what they told me to get their fees reduced. CIA operative. Carried Persian rugs that are here in my office on his back through the desert. And I know this is a fact because his ex-wife, who's a friend of mine, told me how annoying it is to carry a 14-foot rug through the desert. Because there's words on the back of these in Arabic. They probably say like made in Walmart, but I still, never mind. 2011 is a substitute for return. SFR, substitute for return. That means the IRS estimated based on the income documents that were provided to the government, 1040s, or W-2s, and 1099s. The IRS, based on a 1099 miscellaneous income in this case, generated a huge SFR. Current balance is $79,944. Assessed balance is $73,283, which means his first bill, and I'm going to scroll down to Paul E.'s transcript analysis worksheet. This is my own internal thing that I use. I actually typed it for this presentation. When I used to have a huge staff, I'd get all these typed and it would be all whatever. Now I typed this myself, saying that in 2006, you can see here what is due the IRS today. For 2012 is $654.90. 2011, $79,289. Those numbers are added down to the $79,943. The assessed balance for those two modules were $556, which is basically the first bill he got for 2012 was $556. Unfortunately, there were some problems with the period, the decimal points in here. Doesn't matter. With penalty and interest, it's $654. The first bill he got for 2011 on the SFR was $72.7. It's now $79.3. The CSEDs, all the way over to the right-hand side here, can't see me waving, but CSEDs were May of 2024. That's what the May 24 means, May 2024. I'm not bothering with the days in this for this demonstration. So this, when the client becomes first gets signed up, this is my first transcript analysis worksheet. So power of attorney posted, pulled these off of e-services, generated this analysis, saw that the client had an SFR. Scrolling back up, first thing we have to do, the CSEDs are way off due to a late filed 1040 and someone else had done a CDP. Client wants as low of an installment agreement as possible. He is now solely on Social Security income, and really not a lot. I think it's like $16,000 he's on Social Security income. And he says maybe he can pay $300 a month. First thing we do is prepare the SFR protest original for 2011 and the 1040s for, or actually, we prepare all the returns for 11 through 16. But Mark, you forgot 2010, because 2010 is past the statute, past the, at least for our purposes in 2017, you're going 11, 12, 13, 14, 15, 16. That's your 6 years. Practice note, if this was October 2016, I might have prepared 10, 11, 12, 13, 14, 15, because we are in those years. The 2012 1040 is a valid assessment. I'm not messing with it. Upon preparation of 11, 13 through 16, the only tax liability the guy has, the rest of them were zero taxes, Social Security amounts were non-taxable, only 2011 is balance due. The balance due was $13,001. I estimated the client would owe about $19,000. So face to face, I'm on the phone with him. I finished it. I said, "Hey, I finished your return. I think you're going to owe about about $19,000 plus, give or take, after $13,100 of penalty and interest." I had the transcripts in front of me. I saw there were no payments, there were no levies, there were no other subsequent payments. It was pretty clean. I got on the horn with ACS. December 2016, I faxed over all of these returns, including the SFR protest, including the original return for 2011. The IRS on February, so it took them 60 days-ish, because clients, I ask this of myself all the time, how long does it take for an SFR to protest, or SFR to be adjusted? even with Christmas and New Year's, filed in really mid-December is kind of almost a half shutdown time. The IRS employees have one foot in the door and the other on their sled. The SFR was adjusted on February 16th down to 19,005. So I wasn't that far off, give or take a couple percentage points here. So the new transcripts, let me scroll down to the new transcripts, second set, this is what he looks like after the dust clears. These theoretically pulled today, which state he still, notice his assessed balance hasn't changed. His assessed balance cannot change. And actually that doesn't, his assessed balance, why did that change? Ignore the assessed balance for right now as far as it changing back and forth. The 2011 you see is now the 19,565. His 2012 was, as we talked about, was not going to mess with that, $655. His total assessed balance is $18,000. His total regular balance is $20,000. So let's, all you do is take a calculator. 17,963 divided by 72. $249.48. $250 is the installment agreement I could get this guy. Many times I will take the 20,000, 222, divide that by 72. I come up to 281. The client can get a $250 a month payment plan. In this case, I opted for $300 for a number of personal reasons between him, me, his ex-wife. He wanted to have the lowest amount. He could said he could pay $300 comfortably. I did $300. So that's Paulie. Next victim. The ante's going to go up a little higher here. Boyce. 2009 through 2015, 1040s, $32,400 balance, assessed balance of $26,600. The CSEDs are 7 to 9 years away, way down the track. Client wants $500 a month. Case is an ACS. I got $420 a month. And just look at the basic math here. 32.8 divided by 72 is 457. 26.6 is 370 a month. ACS rep offered me 420. I did not beat the person up over the 420. It's less than what my client wants to pay every month. It fits within between my 457 and 370, just taking a simple calculation of divided by 72. When they offered me 420, end of conversation, yes. What day of the month? 28th in John's case. My case is the 21st. 21 is my number for a number of personal reasons. And I set up the case for the 21st of the month. I tell my clients to mail it on the 15th so that it's posted. It's not going to post by the 21st, but I say, listen, I'm setting it up for the 15th or the 21st of every month, but you should consider it as the 15th of every month. Obviously, if it's a direct debit, it's going to come out on the 21st. So scrolling down to Boyce's transcript analysis worksheet, you'll see this is how I do it for multiple years through 09 through 15. The CSEDs are over here in this column. If we have time, because we're down to 25 minutes, basically how I use this transcript, and this is old. I mean, this is an Excel spreadsheet from 2002. Still works today. This is what I've actually asked Roger Nemeth and Canopy and Pitbull to mimic my layout here. Of course, because I'm comfortable with it. Type of tax all the way over to the left. I literally, for this course, was using Roger's, I went through about 3 of these examples, using Roger's transcript analysis. It's a landscape version. And to get, for purposes of showing it to y'all on screen, I had to fold it or cut it and copy and paste to get the columns that I wanted to show you. So this is the kind of stuff I was talking to Roger about. I feel aesthetically for a transcript analysis worksheet to have the typo text all the way to the left, the period or year. Right away, I want to know the next column, how much is owed to the IRS. I don't want to have to, and I love Roger, but I've given him the suggestion, I don't want to have to look all the way over to the right-hand side, all the way over to the right-hand side of this thing, and with these teeny tiny little lines, even though they're gray, they're off gray, they're these reports through Pitbull and and Roger will alternate the lines of grayness in the background so that your eyes can follow 2014, $1,897, 1751, go all the way across. I told all of the players, I think you should move all that stuff over to the left aesthetically so I can see what the person owes. I don't want to have to look all the way over to the right, because what I end up doing is taking a pencil and writing in 15, 14. I've got good eyes. I'm 25 years younger than the average enrolled agent. Most of their people are not as young as I am and have as good of eyes, and so if I'm complaining about the aesthetics, what were you going to say, John?
That was pushing it, because the average enrolled agent is about 60, at least the average NAEA member, and I don't think it's 25 years anymore. 1994 it was 25 years, my man. But
that's okay.
So that's another 25 minutes of Mark already. So we have to ask you another poll question, please. Remember, you need to answer 75%, 3 of the 4 questions in order to get full credit, and you have to be on for 100 minutes. And then there's a bunch of questions. We're going to hold them till the end of the 100 minutes. If people need to go, they're going to go, and at the end of the 100 minutes, we'll hold Mark captive to answer some more questions. About 12 of you have not voted yet, so if you'd please vote, we can move on. Mark, you can speak.
I will say there's a little question down in my chat box, which is, what do you do if the client can't afford to pay you 10% of the savings? That's a simple answer. You got to roll with the punches. If the guy says, I can't pay, and again, let's throw out a number. You save the guy $5 grand. That's $500 that they got to say that they're supposed to pay you. You have a choice. Only you can answer the question. What do I want to do with this? I don't think in any world you don't do the deal. A, they're probably lying to you. B, take $50 a month forever. Well, you know, whatever the math.
Well, Mark, one thing to add here is that Mark uses a service where he's able to debit bank accounts in a specified day of the month, so he's not going to rely on that person actually paying him the $50. They're going to sign a document allowing Mark to bang the account for $50 a month.
Which, John, that was 1994. No, I have gotten away from that direct debit in a bad way. I've gotten out of the direct debit client fee payment thing, but the theory is there. Yes, I will set up methodologies, but if you've got one representation client who owes you $50 a month, you're going to remember the guy. You put it in Google Calendar. On the 14th, you bang his credit card every month for that $50. So you can either cut your fee, obviously choose not to do it, take the money over time. Those are your options.
And for what it's worth, there are services out there that do that part for you, Mark. You put down $50 a month for 5 months, charge them on the 15th, and you don't do it. This is 2017, not 1994.
Yeah, hey, that's right. Okay, so, boys, what are you doing?
Just showing the answer. You keep going, buddy.
Okay, because I know when I know you're in control when I can't see us anymore over there in the corner. So all these periods, you know, there's just the same numbers I used in the cover sheet. Harold and Barb index. Scrolling down, Harold and Barb. So they've got 1040s for 08 through 15. 2016's filed and paid. Their current balance is 83.4. Assessed balance is 68,000. Again, CSEDs are way off. I didn't throw any curveballs in here, but the client, as usual, wants the lowest IA possible. But when you do the financial statement, because this is over 50 grand, you absolutely did do the financial statement. You show the ability to pay over $3,000 a month. They want tiny. you're pretty confident with national standards, or even all day, they can pay $3,000. Client does wisely want a direct debit installment agreement. So we swing back to let's look at this transcript analysis. Okay, you got your assessed balances here. I'll scroll so we can see the dollar amounts. You've got your numbers here, 14, 15, 13, all these years. They're owing. They're pretty consistent in their failure to pay. 83,000, assessed balance of 68. They're in that window of over 50,000, under 100. We can get 84 months to pay. ACS rep pitches me at $1,000 a month on the phone. I take it. It's a third of what their financial statement shows they can pay. It's the lowest number I think I can get. It fits the IRS parameters. If I fight, they pay $3,000. So don't fight. Take the $1,000 a month. Let me show you this 433D that I faxed over to the IRS to ACS to get this set up. What did I do wrong is down right here. I signed their 433D. New York State banking laws and federal, well, let me just say, it wasn't the IRS that cared. The ACS rep said, okay, thank you, got it, I'll process it, no problem. They sent me a letter, not this letter, but they sent me a letter which said, you need to submit a financial statement. We'd like to set up your payment plan, but we need a financial statement. Well, I know I went over a verbal financial statement with the person on the phone. I have the 433F right in front of me. I know I sent it. I know we discussed it on the phone. What they really meant to say was, Dombrowski, you screwed up the 433D because due to banking laws, not IRS laws, the taxpayer must sign and initial the 433D. So even after doing business for over 20 years, I still didn't learn a vital piece of information, and that is the taxpayer has to sign the 433D. So neither myself nor the ACS rep saw this as a problem. My client wanted a DDIA. I signed the 433D, sent it over, faxed it over. So what happened is I had to send this letter, which is the letter telling the IRS in response to the letter 484C dated this date, we hereby request a $1,000 a month installment agreement via direct debit. We request that no further liens be filed as the installment agreement is paid, meaning so long as they're in compliance. The assessed balance is 68. It meets streamlined. We previously secured an agreement. And I wrote right in here, I believe the fact of the 433 that I signed the D, delayed resolution. New York banking laws require the taxpayers to sign the D. Enclosed fee, please find the requested taxpayer signed 433D, the 433F, and what was the last thing in there? The 2848, just the power of attorney I threw in there to establish the installment agreement. And I told the client it's a full pay. You better keep paying your $1,000 a month until this payment plan gets established. So that is how I did it to resolve the case. $1,000, it's 83 grand. 84 times 1,000 is obviously 84,000. That's how we did it. Stephen Lynn got no cash. Now this is a partial paid installment agreement example. I will apologize for the final page, almost the final page, which has my handwritten notes, but I wanted to show you guys, as I usually do, a real life, what I actually used in my practice to figure out what a client's ability to pay is. And this PPIA is going to take some brain space, meaning stop Facebooking while you're watching me if you want to learn something from this. You gotta pay attention. Did we lose? We lost John's video. Oh well. So 1040 taxes 2002 through 2011. They owed 284. This was the client who's a third time they've come back to me. They owed 282. That's the balance when they came back in 2014. When they came back to me, they had paid down $58,000 or something. They owed $224,000. These people were insane. There's so many emails back and forth to these people, the husband and the wife. They always had to be on the phone. Lynn was always second-guessing anything I did. I could hear in the background, ask him why this, ask him why this. I had to sit there, send so many emails of why they still owed $224,000, and when it came down to it, praise the Lord, it was simple math. They were paying $2,300 a month. This was, I had previously sent them up on a PPIA of $2,300 a month. 24 months expired, the case came back out into ACS. They screwed around with it before coming back to me. Now, I was still POA, so I saw the CP 523s. I saw a letter saying we cannot set this up until you get an installment agreement. I had sent them an email saying, hey, do you still want me to represent you? They didn't. They said, yes, they do. But then they didn't call me or do anything for a period of time. They rehired me in August of 2016. They wanted to continue the $2,300 a month. That was their goal, $2,300 a month. Now the balance is $224,000, and let's look at, sorry to scroll down so quickly, this is my August 23rd, 2016 transcript analysis. They owe $224,000, 2002, they skip 03, 4, 5, 6, 7, 8, 9, 12. Look at our CSEDs. Now we're in last summer in this virtual world here. So I got 1 year. What's 12 times 2,300 is $27,000. So I know if they're paying $2,300 a month, they're not going to touch $81,693. So we know $50,000 at least is going to fall off the 10-year statute. The next year, 2004, just through some weird thing, and that I'm giving you these examples because here's real life where their CSEDs are all over the place. This isn't a class about why one CSED for 2002 was longer than the CSED for 2004. It's just not right now what we're getting into. But you can see this CSED is January 2017, $26,000. None of that's going to get paid. Zero of it. Because based on, just ironically, the assessed dates, when you make payments in an installment agreement, this is a fundamental question, I should have put in my notes. When a taxpayer formally establishes an installment agreement, they are not allowed to designate the payments. $2,300, we'd want to pay off 2012, we'd want to pay off 2009 maybe, get rid of 2006, clean up these little years. We want to pay 2011, 2010, so that these other years start falling off the 10-year statute in 2018, 2019, don't we? So the law is that you cannot designate payments in an installment agreement. The IRS designates it to the oldest open assessment. In this case, I'm telling you, it was 2002. I actually modified the columns here that I said do assessed balance. I didn't generally have those in my things. This column said assessed date. So back before we had Rogers software and Pitbull and different things like that, I did my own calculations based on assessed date and looking at the transcript. So a lot of these, even though the staff would type them for me, I'd have handwritten notes all over this in a working file, because it's reality. Let me scroll back down here. So we've got 2024, 151 is the assessed balance. This RO, I can't do just a 72-month payment plan because that will not call for this to be paid off within the statute. It must be a PPIA. The client gives us this ridiculous, for somebody between the two of them making like $380,000 a year, whatever the number was, $250 or something, this financial statement they gave me, page 2, and it was really, really light. Like, I darkened it up for you guys. The front page didn't matter. There was very little on it. This is what they gave me. This is real life. And they included their federal installment agreement of $2,300, which you don't do on financial statements. I'm telling you guys, you don't put your installment agreement amount because it's not ironically, it's not a legitimate expense because you want the end product of your financial statement to show what your ability to pay is, your client's ability to pay. You get the best CIS, the collection information statement. That's 433F, 433A. You get the best thing you can. Here is my CIS. Now the CIS, collection information statement, is sort of a generic, not sort of, it's a generic term used by the IRS. A CIS could be a 433A, could be a 433F. It could be, as I'm showing you here, my work papers. This is my CIS. Is it unprofessional to show you guys this junk, the way I handwrite and all that stuff? I'm sorry, but this is the real world. They made 12 grand a month. National standards are there. I came down all the way at the bottom. And I had actually, these little marks are, when I'm talking to ACS on the phone, I check mark off what I gave them for $200 for maintenance, $211 for insurance, $265 for cable. I did another check mark through because the IRS person and I said, they came back and said they want this huge amount. And I said, wait, we got to go back over the financial statement. What do you have for gas? What do you have for electric? What do you have for maintenance and insurance? So I will double check these things to get back and figure out what's going on. Down here, my DI, disposable income, was $1,366. So here I am saying, wait a minute. They can pay $1,000 less than what they were paying before. And I've got statutes that are going to blow. So when you have statutes that are going to blow, your goal as a practitioner is to try to get as low of a dollar amount because you're throwing that money away. They can't do an offer in compromise. I'm just rolling forward, putting the needle of the record forward. Can't do an offer. My goal is to get as low as a payment as possible so that I can get them past these C-sets. I'm going to get them. I pitched 1366 to ACS in September of 2016. ACS is chewing on it. What happens? Case gets sent out to the field. No reason. I didn't ask for it. I certainly didn't ask for it. Scroll back up here. Sorry, guys. Okay. I didn't ask for an RO to be assigned to the case. And it was their old RO that I had dealt with in 2014. Actually a nice guy, a very intelligent revenue officer. He didn't particularly like Stephen Lynn, and I know why, because they're annoying, but personally, in the middle of this, the client loses his job. He has a good 45, 30 days of notice saying, December 31st is my last day, and it's the bulk of my income. The revenue officer, even after, in January of 2017, the revenue officer says, I got your financial statement, so I had to convert this 433F into a 433A, 3 months of supporting documentation, which was voluminous. Sent it to the RO. He wants $37.45. I start talking to him, and I go, you know the client lost his job. And it's the old, he didn't know that. He says, let me get back to you. In May, we still go back and forth through tax season, April, February, March, April, going back and forth. I set them up on an $1,100 a month installment agreement, increasing to $4 because his 401k loan, the revenue officer allowed at $400 a month, was ending in 20 months. So in 20 months, it goes up to $1,500 a month from $1,000 a month. When I pulled transcripts, did I show you those? I did. The very last page of the material. Look at these transcripts that I pulled this week on this client. I mean, I'm not showing you the transcripts. I'm showing you the transcript analysis. This was the client's 433A that they went from $12,000 a month to $72.94 a month. Let me show you this. This is beauty. They went in 2.5 years, 3 years, they went from 282 down to 117, having paid 65 of that. They did pay $2,300 a month for 24 months. They're making estimated payments in 2017 of $14,000, which probably honestly aren't enough. Funny thing is, this $14,000, I'm pretty sure the revenue officer and I insisted while we're doing this, you must make estimated payments to the day. They put that $1,400 in. We set up the payment plan in May. I'm pretty sure they didn't make any payments after May because we weren't on their thumb. We weren't under the thumb or whatever. We weren't hounding them to make estimated payments. If I really was a diligent EA, I would send out an email to Steve and Lynn and say, hey, is $1,400 a month? Is $14,000 enough estimated payments? I gave you a gift of an $1,100 a month payment plan. 2002 and 2004 fell off the 10-year statute. A huge amount of money fell off the 10-year statute. So, and look at this stuff. We've got in November, we got another $23,000 around Christmas of 2018. Oh no, yeah, Christmas of 2018, another $25,000 falls off.
Now, do you get a third each time that happens?
No.
Oh.
No 20% of savings on that type of situation. And you know, and I wrote these notes here. It was 282 in 2014, then 224 in 2016, and then the CSEDs hit to get it down to 117. Now, you know, you just $1,100 is a gift, and just in my mind. So that is the end of my presentation with 3 minutes to go. So let's have some questions. Let's.
So you need to hang out for 3 more minutes, even if you have to go. Stay for the 3 minutes so we can give you your full time. Let me ask the fourth poll question, Mark. While we have them there, then pretty much that'll wrap it up, and you can do all your questions. So if we were to put together a practice management program, we're thinking it would be, so half rep, half prep. It would be 4 hours of best practices for any practice, 4 hours of somebody who knows what they're doing with tax prep, and then maybe 4 hours of somebody who knows with what they're doing with the representation practice. Mark, that may not be you based on your 1994 prices.
Better be me.
Well, actually, I'm thinking it'd be a 50-minute segment. Don't let this happen to you.
Yeah, don't let Hart Dombrowski price your cases.
Okay, there's about 6 people that haven't voted yet. About 4 now. 3 people haven't voted. You're logged in, but you haven't voted. Get off the other screen. Get off of Facebook.
You know how hard it is for me not to Facebook for 2 hours? An hour and 40 minutes is ridiculous. It's like I'm
one more of you. Come on, I want to close this up.
Using for a Facebook hit here.
Okay, so I'm going to close this up and show you the results. Mark, it looks like I'm not a fan of delivering stuff over a webinar. I think live is the way to go. But all these people want webinars, so maybe doing it live and having it recorded is going to be the option. What do you think?
I think we need to think about it and say whether or not we want to do. Do we want to do these things in our pajamas like everybody else right now? No, it's 3 o'clock Eastern time here. They're not in their pajamas.
I want to do like Kevin. Kevin says we need to get a stand and speak, so it's like we're really in a room and we don't slack off.
I can put together something. You know, you do blue screen, John. You do a blue screen behind us, and then I don't know. It's 2017, baby. You can put anything. I can have a beach behind me.
Well, you know what we should do is Arthur. We got to talk to Arthur Werner, and we might have to go to Philadelphia and film in his studio. Yep, and he's got all that green screen there, man. It could be amazing. You have that. When you were doing MSNBC stuff and CNN stuff, like. Yeah. You were in your living room and they projected something behind you, right?
No. I went every time I went to a studio.
Oh, you did? Okay.
Yes.
Okay.
Yes. I went to a production studio in there. Like I went to the NBC affiliate in
Buffalo or wherever you were.
Or New Jersey.
Okay.
In half suit, just shorts, but this, and it was floating
I
head.
knew that, but I figured everybody here did not need that visual, man.
Shorts, not.
So let's ask some of these questions. Oh, Pamela Jip, longtime listener, first-time questioner. If you set up an installment agreement for a client for 72 months, do you provide any information to them as to how much they will actually pay in additional penalties and interest over the 72 months?
No.
And I would say, do they care?
I have never, and I'm saying that in such a manner that I have never, because it's, have you ever looked at your mortgage? 30 years, for those of us who are, when I was younger and you have 30-year mortgages, all that stuff, even 15-year mortgages, you're still looking at, it's like, what the heck am I paying? So I do not torture my clients by showing them that number. Next question.
So, all right, and anyone that needs to go, you've earned the 2 full credits. You can go, but we're going to go through the questions and anything else that comes up. So getting 72 months twice is possible in certain cases?
Absolutely. You can go back to the well again and again and again. What the determining factor for that success rate is going to be the CSED. You have a client who you set up a 72-month payment plan, they lose their job, they add another period, which is more likely going to happen. So you can get multiple back-to-back 72s, yes.
Is it normal to work with ACS when an RO is involved?
That is not only not normal, but it's not allowed.
It's actually one or the other, right?
Yes, yes. You to think about it. Why would you ever put yourself through that? Obviously, you're not doing it on purpose. You have to say to ACS, here is the phone number, and if you need to say to the revenue, well, you say to the revenue officer, listen, something's wrong with your case assignment. There are 10 periods that you're working on. 2 of them are still in ACS. Go into your computer system and move those into your inventory because I'm getting phone calls from ACS and I'm not going to answer them. And if ACS levies them, it's on you. It's really the revenue officer's ultimate responsibility, the group manager, the group secretary, to make sure that all those modules are in the RO's inventory. So it is a mistake. It has to be worked. And then the answer there is it has to be worked by the RO, not by ACS.
So David asks, can we have a future seminar using tax help software or civil reports being used? So the problem is they're a little bit harder to redact, but yes, we can. Personally, I'd like to get Roger to come on and do a seminar for us. Certainly his father, Bill, would. But one of the things Mark and I are working on is ways to make off-season revenue for you, and using Roger's software will be part of it, but that's coming up.
This is what I had to do. Make sure this is redacted. This is what I have to do. This is what I was doing to get it the right. I'm sorry for this. It's because it's opposite. That's what I had to do to use one of Roger's reports. I had to cut it.
Does Roger have dummy reports? Does he have dummy people he uses for testing?
Yes.
We could probably ask him. He likes us. Well, he likes me. Maybe we could get something for that. But also, we don't want to be heavy on any one particular product either. The idea here is to talk about theory, but maybe we can do something. If tax is owed for CSED expiring before the 72 or 62 months, what do I do? Do I take the remaining CSED by month? How does that work?
Take the remaining CSED by month. So if there are, and unfortunately, every week, every month, as the case moves forward in ACS's inventory, that's one less month that you can pay it. So yes, you ultimately, even if, let's say the person qualified for an 84-month thing, but the CSED's going in 49 months, you just divide the number by 49. That's how they do it. Does that answer that?
Yeah, yes, it does. Does the CSED get extended while the partial pay installment agreement is being negotiated? And I think the answer is no. The clock runs.
No. So, okay. And this is a sort of, Roger dealt with this. We have to deal with it, but you do not worry about your PPIA negotiations in relation to the CSED. That's my practitioner advice. That's minutiae. It's too much. You're getting into too much. Don't worry about it. It's not like filing an offering compromise or bankruptcy or an appeal, all that other stuff, which legitimately are an action of yours that absolutely extend the statute, and your butt is on the line. When you're negotiating a PPIA, you have to do it. There's no other way around it. My personal experience, I have never had a PPIA logged in and extending my statute. There is a 45-day window of negotiations for any installment agreement, whether it ends up being a streamlined installment agreement or a PPIA, where when the revenue officer or ACS puts in the code PPIA, or sorry, installment agreement pending, by law the IRS cannot levy for 30 days. So the law, Congress protects itself and says, okay, anytime there's a pending IA entry on its transcript analysis, or a transcript, we're allowing 30 plus 15 days. We're allowing 45 days to be added to the 10-year statute. Generally, it doesn't matter because it's only 45 days. It's not like an offering compromise where you can add 5 years onto your statute or 3 years on your statute. So, and we were talking about this. Me, Roger, a couple of us professionals were talking about that. This summer happens to be the summer of do installment agreements extend the 10-year statute? And I agree with Roger, who said that it really comes down to, did the revenue officer or ACS rep make that entry, and did it ever matter? So the answer is, you're doing an installment agreement negotiations, don't worry about it. You're going to be doing those. If later 45 days gets added on, don't worry about it. I have had, as a practice, Tax Help Associates, my old partner ran into it, and we had done an installment agreement that had extended the statute, an installment agreement negotiation, for 6 years. So there are extenuating circumstances where that really comes to hit you in the butt. My practice note is, once the installment agreement is set up, and like 3 or 4 months later, I will go pull transcripts to see that PPIA established, that installment agreement established, is noted. So let me clarify that. If you are working any installment agreement, whether it's PPIA or a regular installment agreement, it is prudent for you to have your transcript, a snapshot of your transcripts printed out, or at least saved somewhere, PDF. It's 2017. We want to go paperless, but look at your transcripts to say PPI or installment agreement pending, and then the next line should be installment agreement established. The time when we extended the statute 6 years was because there were no, ACS lost the case. Back then, we thought, oh, this is great. It wasn't so great in the end. So that's one out of thousands of cases where we got that. And actually, Roger and I were talking about how there should have been something done back then to stop that 6 year. But I guess now that I think about it, was the questioner's real question, does the 24-month, because it's a PPIA, is the CSET extended by 24 months? And that answer is absolutely not.
Well, she did say while it's being negotiated. Does the CSET get extended while the partial pay installment agreement is being negotiated?
In theory, 45 days.
Good deal.
In practice, none.
So this is a good question, and off subject.
John, they're all good questions.
But do you know what the memo, initial levy imposed, showing up on IRS account transcript means? Nobody at the IRS seems to know. So my immediate response would be, what's the 3-digit code? I know you know, but what's the 3-digit code to the left of it? And you can look it up. Clarice often shares that pocket guide to the codes. Yeah. But go ahead and answer that, Mark.
Well, here's I don't know the answer. Here's the answer I give. The answer is, I feel personally, and no one has yet to refute me. Even all these these young kids, these up and coming kids like Jeff and Clarice, and all these up and coming rep people that are pushing us old dinosaurs out of the way.
I kick your ass for calling her up and coming.
Clarice actually invited me on one of her mountain bike tours and pushed me off the mountain. She physically said, "You're the dinosaur. We'll find your remains 3 million years from now." Pushed me off a cliff. The answer that I feel is that, take this for what you want. I feel that somebody higher up at the IRS wanted a benchmark. They wanted a line in the sand for the tax gap. And they told the people at IRS Computer Wonderland, give us one day. I think it was like March 17th, 17th, or 2 dates, like March 17th and I forget the other date. All the people who know it are shouting it out right now. Mark, it was April 25th or something. But there were 2 sets of dates that all of my clients seem to have the same date on their transcripts. And I feel, and like I said, no one has yet to refute me or come up with a better answer, that somebody in Congress, somebody in Ways and Means, somebody wanted a benchmark.
Clarice has an answer. It is
No,
mentioned.
Stop.
Well, all right. Clarice says, no one really knows the answer. I was told by IRS it is related to passport revocation. Now, we all know the PATH Act, we've had 2 or 3 years where the IRS could revoke the passport if you owe $50,000 and have it entered into an installment agreement, but they didn't have a system in place for the IRS and the State Department to communicate. Actually, they didn't have the law, the mechanism either, and the PATH Act gave us that. There's now a way to communicate. So Clarice says the IRS thinks that it was that. It's also mentioned in the IRM under OIC, Code 971, by the miscellaneous catch-all. Interesting.
Yeah, I think that's actually legitimizes my answer. Somebody wanted a benchmark, whether it was for the PATH Act. But so that's that. You know what? That is the answer. You can take that one to the bank.
Gotcha. Would you believe that's the end of the questions?
I would love to believe that.
And there are still 38 people on here listening to us. That's terrible.
Well, now we start the real horse and pony show.
If anyone has any ideas for things they'd like to see coming up, please email us or Facebook or whatever. I would hope that in the next 10 days we're going to put up a schedule for the rest of the year so that you can book these things. Also, build it around our travel this year. We're both. You have any travel? Where are you going to be the next couple of months? Besides Hamburg.
3 hours away for Syracuse at the end of September for
September 23rd.
yes, where you will be there. We're staying overnight.
I know. The NYSSEA event. Are you you're speaking?
I am not speaking for the first time in many years.
I am not either. So
and I'm going to pay that. It's going to cost me over $1,000. It's so weird for speakers.
I'm at Kansas NATP October 20th, October 30th. I'm at Illinois Midwest in Motion for Tax Practice Management on October 20th. I am in New York City for the International Tax Festival we produce November 8th, 9th, and 10th. I am in...
you do that, John? You said we produce. Your Tax Practice Pro?
My company produces, yeah. We have a 3-day event. Fabulous speakers. Not me for the first time, but Tom Gorczynski, USTCP.
You're really making money when you don't have to put yourself up there.
Yeah, well, or you're not making any money, but Beth Logan is speaking. Marina Hernandez is speaking. Kristen Davis Howes is going to speak for the first time for us. So it's going to be a fabulous couple.
Kathy.
I'll be in California. Huh?
Oh, I'm thinking of Kathy Remstock.
Oh yeah, but Catherine, you're thinking of Catherine Bostock Hootie.
Yes.
No, no, not her. The last week, November 28th through December 1st, I'll be in California with 3 different days that I'm speaking for CSEA on marijuana. Watch your email for that if you want to come. September 22nd, I am in Spokane, Washington for marijuana. I'm in La Crosse, Wisconsin, September 16th and 17th for the joint Minnesota-Wisconsin event. Boy, I'm running out of time here, right? That might be everything if I forget. Oh, and I'm going to Iowa. I just got reminded by Marty Myers-Garver. So, well, I'm there with Bill Nemeth in November at some point. Oh, November 17th and 18th also, I'm in Colorado Society of Enrolled Agents with a whole bunch of fabulous folks. So I get around. And Clarice said I'm going bike riding with her those 2 days. Of course, it's going to be snow on the ground. So thank you, everyone. It's been fabulous. And any last-minute questions? Yes, Julie, I know about Wichita. Oh, Clarice is teaching with me. Fabulous. She can buy me a drink. I'm going to need it.
I
Ooh,
just had to take a moment because selfie pause.
wow, hang on. Listen to this one. Not that it's a little off topic. So Mariette in Oregon, client informed me yesterday she was the victim of a catfish scam. She loaned this person everything in her retirement account. How will this impact a potential offer in compromise? Victim of fraud. I don't know. That's going to help.
You've got to absolutely file a police report, FBI report, whatever is appropriate, so that you have as much ammunition as possible when you do go to seek relief.
Hey, what about doubts to liability? Can you swing that if you're a victim? If most of the tax bill is you're a victim of theft by trick or device?
I mean, why is it the government's fault because you got rooked?
It's not, but there's also no other tax relief which might be available if it were not pre-tax money, right?
Well, let's just say if she's really lucky, she gave all of her money away, and therefore she's perfect for a regular offer in compromise, and she doesn't have to bother with a doubt as to liability offer. But if the reality is that she can full pay, you got to do, yeah, effective tax administration. Yes, you can certainly do either an offer in compromise, doubt as collectability, effective tax administration, or doubt as liability. But again, you're fighting tax code. She really does owe the money, and the law is she pulled the money out. She wasn't under duress. It wasn't like somebody walked her in a bank with a gun to her head. That might be a little different than. But hey, as advocates, we're supposed to try every trick in the book. So if one doesn't work, you do offer as doubt as liability. Why not? I mean, other than fee churning and all that other crap, he took this woman's money, and she's your victim too. And is that it?
My man, I am doing one last scan here, and I think that, hang on. Oh, Marriott says, but her voluntary donation of the money, does it constitute divestiture? I would say no.
Marriott's always thinking.
Always thinking about her poor client.
Which is what we should all do, in theory. In theory.
So I think we're good. What do you think, brother?
When am I gonna get a tax?
Oh wait, one more question. Chris, do you follow up after an IA is complete to track that people made their payments or have any kind of reminders?
No.
No. Okay. Well, actually, if your power of attorney is open, the IRS follows up for you and tells you that they're about to default.
CP 521 is the payment vouchers that come in, and today I got CP 89s, those annoying letters that say this is not a bill, and they're 3 pages, 2 of them are landscape, and they're absolutely useless. The clients are not on installment agreements, yet they get this installment agreement notice, the CP 89. It's the most annoying bill.
That's taxpayer bill of rights too, where we have to remind you at least once a year you have an unpaid liability.
No, that's a CP 71.
Okay.
Yeah, the CNC notice is a CP 71. This dumb CP 89, and I'm looking. I probably got 8 today, which 6 powers of attorney I revoked today. Yeah. All right, guys. Well, thank you for visiting. Thank you for playing ball with us here today. And John and I are gonna, as soon as the screen goes dark, John and I will be planning our next little webinar here.
Good night, kids.
Thanks, guys.